Hey, thanks for coming to watch this video. I wanted to do this to show you why I think there's such an amazing opportunity in the real estate market right now, and I don't want you to miss out. I've been doing real estate for almost 30 years now, and I've never been in a position to take advantage of a market like this. Ended up buying a house back in February, and it's been a great investment already. And I want to show you why I think that. The media loves to spin negativity because that's what sells. So they've been grasping you and telling you negative things about the housing market. The bubble's getting ready to burst. And I don't think that's true. So I put together this presentation to kind of show you the facts and allow you to make your own decision on whether you think now is a great time to jump in. Now, I'm not the only one that thinks this is a great opportunity right now. I'm here, I've got Barbara Cochran. I don't know if you know her from Shark Tank, but she is a well-respected real estate person out of Florida. She just recently sold her business for over $61 million. And she thinks that housing prices are going to go through the roof. Here's a couple of excerpts from her interview, that there will be a major swing in the real estate market. The minute those interest rates come down, all hell's going to break loose and prices are going to go through the roof. It's going to be a signal for everyone to come back out and buy like crazy, and houses prices will likely go up by 20%. She said we could have a COVID market all over again. So it's not just me, it's other people as well thinking the same way, that when other people are scared to buy, it's usually a great time to jump in. This interview was just done on October 17th of this year too, so it's very recent. So why do we think that? Well, what happens to the housing market at 5% rates? Here's a great quote from hockey great Wayne Gretzky: skate to where the puck is going, not to where it's been. I don't think you want to be in a market like a COVID market in a couple of years when everyone's competing and waiving their contingencies and overbidding for a house. Why do we think that? Housing inventory is extremely tight. This is good for housing values. You can see 2021 inventory was way up here, 2022 dropped, and 2023 is even lower. Also, home prices are increasing due to that low inventory. Here we've got 2021 again, prices in 2022, and here's prices in 2023. You can see that the prices are continuing to go up over time. Here's the 5 top indexes tracking increases in home equity values: Case-Shiller, FHFA, the Federal Housing Finance Administration, CoreLogic, Black Knight, and Zillow. And you can see it started off a little slow here in the beginning of 2023, but as it kind of the year got going, values started to increase, competition picked up. There's still low inventory, so people that wanted to buy had to, get in there and buy and compete. Look at the average pace for 2023 is 7%. So what if we wait for lower rates? Well, let's look at that. We're going to lose out on appreciation loss. Everyone knows, values might go up a little bit over the next couple of years. So what? A little value loss, no big deal. But they also forget about amortization. So every time you make a payment on a mortgage, your balance on your mortgage goes down a little bit. If you're paying $2,500 in rent right now, that's just throwing that money away. You're not getting any benefit from it. So amortization cost is a huge loss, a loss of opportunity to build more equity. The thing I love about real estate is that you can leverage the heck out of it, and it grows in 2 ways. You get appreciation, the value going up over time, and then you get the balance of your mortgage going down over time as well. So it's growing in 2 ways. Pretty powerful. Look at these numbers: 6 months waiting, potentially losing up to $10,000. 1 year waiting, over $42,000. 2 years waiting, almost $80,000 in lost opportunity costs. And I don't even want to talk about this one, $115,000 in lost opportunity. Don't let this happen to you. So media loves to talk about the 2008 housing bubble. And, that housing bubble was caused by high unemployment, subprime loans that people didn't actually qualify for, and then also major delinquencies and inventory. So let's compare 2008 to 2023 and see how close we are. So last housing cycle, this is 2008. Unemployment rate hit a peak in 2009, actually, of 10%, 10.8 actually. Unemployment rate right now is 3.6. Back then we had 138 million people with jobs. Right now we have 161 million people with jobs. So 23 million, 17% more people working. These subprime loans, the evil subprime loans that caused that entire meltdown, by the way, if those loans were not even available, we wouldn't be talking about a housing bubble in 2008, in my opinion. But they were prevalent. They were everywhere. And right now we have virtually none. 5-year cumulative new home construction. This is the amount of houses that the builders are continuing to build over a 5-year period of time. They were coming to market with 7.65 million houses in the pipeline for inventory. Right now, we're down 40% to only 4.6. Inventory in the market, 4 million homes available for sale versus under 800,000 right now. That's an 80% drop in inventory. Holy smokes. And then delinquencies. 3.37, all-time low since 1979, and foreclosures 1.61%, lowest in 23 years. So if we're comparing these cycles, these market cycles side by side, we got super low unemployment. We got more people that have a job that could potentially buy, 23 million more people that could buy, virtually no subprime loans. So everyone has to qualify for the loan that they get so that they can make the payments. You've got way less inventory, new construction coming available. And then you've got way less inventory, 80% less inventory. To me, that looks like housing values are going to stay strong for the long term and start to move upwards over time, especially as rates drop and make the pricing more attractive from that standpoint. So is real estate a good investment? I mean, let's talk about that. You know, historically, let's look back to the 1940s, where I gathered this data. 1950s, 129, 136. 1960s, 70s, 80s, 90s, 2000s, 2010, 2020. I mean, look at these staggering numbers, you guys, on real estate. Year over year over year, practically, you're having some kind of gain. Now, 73 years since 1942 have been positive markets in growth and appreciation. 7 negative years. But let's look at these 7 negative years. 2 of them right here in the 90s, negative 1% and a fractional loss. So not big losses at all, in my opinion. I mean, big deal. You had a couple of flat years, basically. No big deal. And then the other 5, though, are 2007. That was caused by those subprime loans that people didn't qualify for. So if you take these 5 years out, you've had 2 down years and 1 even year here in 1955. Staggering numbers, if you ask me. I mean, look at the green people. If you buy real estate and hold on to it, there's no doubt in my mind that you're going to grow your equity and build wealth for your family. Now, is real estate a good investment? Here's another one. Appreciation after 5 years. You buy a house at 600,000, you put 5% down over 5 years. I'm using a forecasted rate of 3.68%. I think that's pretty low, in my opinion, but let's be conservative. 600,000 in 5 years, you have $718,000 in value increase over that period of time. What does that look like in return on your investment? Remember, you can leverage the power of real estate. So you only have to put 5% down or $30,000 in to make a huge return. Look at that, 377% return on your $30,000. Real estate is an amazing investment because of that power of leverage. You don't have to buy a house cash 100%. You can put a small portion down or even zero down and then get the gains over time. Now, why do we think mortgage rates are going to come down? I mean, is it a guarantee? There's never a guarantee, and no one has a crystal ball, but they are cyclical. They are going to go up. What goes up does come down typically. So I'm going to show you some past economies that had similar situations. This is the 1980s. Inflation skyrocketed from 7 to 14%. Mortgage rates jumped to 18.6%. Fed funds jumped to 20%. Can you imagine that? Inflation dropped significantly by 9% down to 5%. And what happened to mortgage rates? They dropped significantly and the economy went into recession. Here's a Greenspan. This is the early 90s. Here, inflation jumped to 3.5%. Mortgage rates jumped, not a huge jump, but up 1.5% to 8.5%. Fed funds jumped up just under 2%. And then inflation started to come back down as the Feds raised rates. And interest rates dropped significantly, a full 3% drop in rates. But again, the economy ended up in a recession. Now, what's happening today? Let's compare it. Inflation jumps 1.75 to 9.1%. You've got mortgage rates skyrocketing to 8% where we're at today. And you got the Fed funds rate up from 0 to 5.5%. So very similar to this 1980s market as far as the leap, 5-6% jumps here. Now inflation's already started to come down quite a bit, almost 6% from 9.1 to 3.7%. So we feel strongly that the mortgage rate response is going to be very similar to these last cycles that we went through. Eventually, inflation will get down closer to the Fed target of 2%, and then they'll start lowering their rate. And in response to them lowering their rate, mortgage rates should come down as well and start to present, better and better opportunities for lower payments and less interest. Will we end up in a recession? That's yet to be seen. I feel pretty confident that we'll end up in a recession at some point. I mean, it's just such a crazy market, and the government's been spending so crazily that we're probably going to need a pretty harsh recession to pull us out of the inflation in the end of this game. And why is a recession important? This chart is my favorite one on the economy. Is cyclical. This is a Fred chart that I pulled off the internet. And these gray lines are recessions. And recessions are important because they kind of start the cycles. The red line is interest rates over the last 30 years, and the blue line is housing values. The thing I like about the blue line is, look at the blue line, it just continues to go up. But typically through recessions, you can see the blue line, housing values continue to go up over time and time and time again. Now look at interest rates though. Why do we think interest rates are going to go down? Well, here we go. We're going into a recession. Inflation starts to kick up, interest rates go up, and then they go up even further, and then they drop. Then all of a sudden interest rates go up. We go into, here's the 80s we were talking about with the first cycle that we talked about in the last slide. Interest rates go way up here to 18.5%, drop all the way down to 12.5%. Every time we go into recession, interest rates drop. We go into close to a recession, drop. Recession, even in 2008, this recession was caused by the housing market, which is those fraudulent, or not fraudulent, but those subprime loans that people couldn't qualify for, that should have never been available. Even then, during that market, we got into a recession, and what happened? Interest rates dropped significantly. This is the pandemic recession. It's really not a recession. It's more of a economic shutdown, but same thing happened. Interest rates dive down low when you come out of the recession. So even if we don't get into recession, at some point, interest rates are going to have to come down. I believe they'll go into recession. We'll see interest rates drop significantly. I wouldn't be surprised to see them, in even back into the fours, and some great opportunities to refinance down the road. So here's the last white elephant in the room, right? I can't afford the payment. I get that all the time. Payments are high. I get it. My payment was brutal. I'm at 7.5% on my mortgage. I only put 5% down. I've got a very high payment, but I've decided that I'm just going to kind of struggle through, the next year or two until rates drop and take advantage of this great market. That's how strongly I believe in this. So look at it, the current market opportunity with 5% down, $600,000 house, 3% down or 5% down, 8% rate, $48.92. This is principal, interest, taxes, and insurance. So your total payment would be about $48.92, and that includes mortgage insurance as well. If rates drop, say at 5.5% in 2 years, my principal and interest will drop to $38.83. That's over $1,000 lower per month, a pretty substantial savings. And I just can't imagine. Look at the value. I used a conservative value of around 4% here for appreciation, and you're going to have over, close to $650,000 value on top of it. So you're going to owe $565 less money, and you're going to have a much higher value and $1,000 plus lower payment. So amazing, I think an amazing opportunity. And this is what it really leads to. Now, here's a future market opportunity. I want to compare this to waiting. So price is now 650, because remember, 2 years from now, our value is 650. We had put 5% down, same amount down, but look at our loan amount, 617,500 versus 570. Our payment is now 4181 at the same rate of 5.5. So 4181 versus 3883. Which payment do you want now? Right? Refinance opportunity, none. There's nothing available to you. Now, rates may continue to go lower. Maybe they go down to 4.5 or whatever. And yeah, you'll have a refinance opportunity there, but you'll also have it here too. Now, if you can't afford the payment, there are some programs out there that I feel good about that I would, talk to you about to help you get a lower payment short term. These are 30-year fixed loans. They're not adjustable rates. And it's called a 3-2-1 or 2-1 seller buy down with only 5% down. Now, what that looks like is the seller actually pays interest ahead, puts it into an account to subsidize your payment for either 2 or 3 years before you go to the fully indexed payment, giving you a lower payment. So year one, you buy the house for $600,000, you put the $30,000 down, the 5% down, you get a 5% rate the first year. So your rate's actually 8% on a 30-year fixed, but the seller is subsidizing a buy down to give you a rate of 5% for the first year. So your first year payment, including taxes, insurance, and mortgage insurance, is only $37.68. After 12 monthly payments, it goes up to $41.26. After the second year, it goes up to $45.01. And then after the fourth year, it goes up to back to the normal payment that you would have paid anyways of $48.92. And then it's locked in for the rest of the term at that. The goal of this program is to give you some relief in the first couple of years until rates come down, allow you to be able to refinance and put yourself in a great position to lock in a lower payment longer term and take advantage of the amazing appreciation that I think is going to come down the pike. Thanks again for watching. I really appreciate it. I hope you take advantage of this market, or at least I hope you can look at this information, see the opportunity is there. May not be an opportunity for you right now, and I totally understand that, but I want to make sure that you don't miss out on the opportunity by getting bad information. I presented some facts today. I showed you some cycles and how the economy is going to function over time. And I feel like there is a lot of things pointing to an amazing market down the road, that if you're looking to buy a house and stay in that house for the next 3, 5, 7 years, you're going to have an amazing growth in equity over that period of time and start to really create some great wealth for you and your family. So I will hopefully hear from you if you have any questions. Otherwise, thanks for watching, and we'll talk to you soon.